What is dollar cost averaging? How it works? And does this risk reduction tool make any sense for you in the current investment landscape? Welcome to Money Anna channel, and here is a 5-minute summary of what you need to know about DCA. Alright, dollar cost averaging is an investing strategy to mitigate market timing risk. And you definitely need to understand this strategy when creating and managing your portfolio. Basically, what it does is that it reduces the chance that you'll put all your money into stocks just before the market slumps. A simple example. Adam has $5,000 that he wants to invest. He can invest all this money right now, or he can space it out over time and invest $96 every week during a whole year. Which way would work better for Adam? As you probably already guessed, it's not that black and white, and there is no one right answer, because it will depend on market's behavior during this specific year. If the markets are growing, the best thing to do is to have all the available money invested and working as fast as possible. This is called lump sum investing, because it's about investing all your available money for investing in a lump sum. Otherwise, if the markets are dropping, DCA strategy would be the right choice. You cannot time the market. You can't predict the future, but what you can do is to educate yourself, keep your eyes and ears open, and sometimes just trust your gut feeling. What do you think will be happening during the next couple of years? Will it be sustainable growth, or is it a recession we have to prepare for? Please answer under this video and we can discuss it further. My opinion, just a humble opinion, mind you, is that the current economic situation is terribly unstable and we can see a long recession very soon, unfortunately. Some of you, especially younger people watching this video, might be thinking, I don't know about stock market. I don't understand it. I'm afraid of it. And why wouldn't you be? Who has ever taught you this? It's not like you come out of school knowing what this is and how it works, but I think the message for young people watching this, or any people, is that you need to invest. And one of the many reasons why you need to invest is because you will need to save for your own retirement. If you're employed in the gig economy, you will not have a pension. And even if you have a full-time, permanent, staff-type job, pensions are disappearing. Which means that you need to start investing as early as you can, for as long as you can. Okay, I'm off track now. Please take a moment to like this video and let's move on with DCA. To recap, the goal of the dollar cost averaging is to reduce the overall impact of volatility on the price of the target asset, as the price will likely vary each time one of the periodic investments is made. The investment is not as highly subject to volatility. Dollar cost averaging aims to avoid making the mistake of making one lump sum investment that is poorly timed with regard to asset pricing. You also need to understand that DCA is a tool an investor can use to build savings and wealth over a long period. It is also a way for an investor to neutralize short-term volatility in the broader equity market. A perfect example of dollar cost averaging is its use in 401k plans, in which regular purchases are made regardless of the price of any given equity within the account. In a 401k plan, an employee can select a predetermined amount of their salary that they wish to invest in a menu of mutual or index funds. When an employee receives their pay, the amount he or she has chosen to contribute to 401k is invested in their investment choices. Investors who use a dollar cost averaging strategy will generally lower their cost basis in an investment over time. The lower cost basis will lead to less of a loss on investments that decline in price and generate greater gain on investments which increase in price. The usual time periods tend to be close to a month. However, there is no best frequency. In addition to no best frequency, there is no minimum amount of money required to dollar cost average. As long as you have enough to purchase one share, you have enough to dollar cost average. Usually employed by long-term investors, this strategy is used to limit the negative effects of the market on your intended position. By purchasing at continual intervals, you keep lowering your average price per share, and this limits your losses and increases your potential for returns. Dollar cost averaging can also have the opposite effect. If your selected stock is always up in price, when you purchase them, your average price will become higher, which lowers your return when compared to dumping your principal at your initial position. When the stock is down in price, you will be buying more shares at a better price. This will help you fight human emotion and buy stocks at attractive prices. Starting by dollar cost averaging will help you learn your way around investing and is a great way to get started. If the thought of investing your money all at once and potentially seeing it fall in value shortly afterwards fills you with anxiety and paralyzes you from investing it at all, then dollar cost averaging can make a lot of sense for you. Because investing is a long-term game, and the earlier you start playing, the better for you. Have a question? Just comment below this video and you'll get your answer within 48 hours. Subscribe to Money Anna channel and check out my educational videos about personal finance and investing. Have a great day, have a wonderful life. See you soon. Bye.